With me is Michala Marcussen, Head of Global Economics at Societe Generale. Thank you so much for coming in. Michala, in terms of what inflation risks as a problem, we're already hearing that there's a likelihood that central banks around the world will put interest rates higher because of renewed inflation pressure. Are you concerned that these rate rises will be sooner than actual growth will be able to take it?
Well, I think the more hawkish noises that we've been hearing from the central banks may actually end up being wrong-footed, because to my mind, what we're seeing right now on the higher inflation number is being driven by supply concerns in the oil market, which means that it's actually a very negative shock for the economy in terms of growth. Just to give you a sort of rule of thumb, if we have a $20 per barrel increase in the oil price, which is from a supply side shock, that could take anything from a half to a full percentage point off global growth, and that's not really something that central banks should be responding to by hiking interest rates. Now, of course, the concern is on the second round effects that could come, but that requires a very long period of higher oil prices, and this is where the ECB expresses its second concern, which is on the demand side that's driving commodities as well from the stronger growth in emerging markets. So we have these contrarian forces on the inflation picture which are pushing ahead, and at the same time the core inflation rates in Europe are such that there's really no indication of second round effects coming through. So to my mind, it's still too early to call for rate hikes from the ECB based on the current inflation picture.
So, Michala, what kind of a time frame would you be looking at the ECB to raise rates? Are we talking not only later half of the year but possibly into 2012?
Well, I still think that the ECB could possibly wait until 2012, because there's the second dimension which the central banks don't really like to talk about quite so much, but which is very important, which is the financial stability. And if we look across Europe today, we still see a number of issues on the financial stability coming from the sovereign debt crisis. The Irish election could be another source of financial stability woes. And of course, we have to remember that what's happening on the oil price, threatening the recovery, comes back to financial stability as well. And I think for that reason, it could be much harder for the ECB to hike rates than what the market is currently pricing.
Now, Michala, of course, as oil advances for a seventh day, estimates are widening about how the price could go. And at the top end, I want to bring you some of the estimates. Nomura says that it could hit a staggering $220 a barrel if exports in Libya, but also in neighboring Algeria, are hurt. Do you have any kind of forecast on what the price of oil will be? And that, of course, will give us an insight into, well, how much inflation will grow across the world.
Well, our oil price forecast is much more modest than that. We're looking for oil prices to be in the $100 to $120 per barrel range over the coming years. But I think what's very important to look at is how much of the oil supply is impacted. And Algeria and Libya combined are relatively small markets, relatively small. But what the concern is, if this starts spreading into the wider Middle East, starts spreading into other areas, Iran, it could become much more of a headache for the oil price. In that case, a forecast of $200 per barrel may not be quite so extreme. But I think what's important to remember is that we do still have spare capacity in the oil market, and if this proves a more durable situation, that spare capacity could be brought out.
Michala, thank you so much for joining us.